Hello, thank you for tuning in to Tax Tips and Best Practices for Working People. My name is Nicola Price, and I am going to share some tips on what you should do if you receive a letter from the IRS. The primary way they communicate with taxpayers, such as you and I, is via mail. So they won't call you, they won't text you, and they won't email you. If you receive a letter from the IRS, open it, because oftentimes you only have a limited amount of time to respond to this letter. There are various reasons why they send these letters out, but the most common reason is because there is a mismatch in information they have and the information reported on your tax return. This mismatch will result in a letter to the taxpayer. Like any other business, the IRS will automate some of their processes to be more efficient. And the system they use is called the Automated Underreporter Response Program, or AUR for short. In this program, whenever it detects a mismatch in income they have and the income you reported on your tax return, it will automatically spit out a CP 2000 letter to the taxpayer. Now, the CP 2000 will detail why they're contacting you, the proposed changes that they made, and what you need to do about it. So if you agree with the changes, then you just simply sign the letter and mail it back to the IRS. If you disagree with the changes, then you will be given an opportunity to provide any proof or documentation to support your position. Some reasons income go unreported is because the taxpayer did not receive the tax form or they simply wasn't aware. So I'll give you a few examples. Anytime debt is canceled, whether it is credit card debt, car loans, consumer loans, student loans, any type of loan canceled or written off by the debtor is considered taxable income to the taxpayer. So the debtor will report this income on a 1099-C, and they will mail a copy to the IRS and a copy to the taxpayer. Another common example of unreported income is proceeds from lawsuits. Internal Revenue Code 61 says all income from whatever source derived is taxable. The exception is if there is an exemption for those proceeds outlined in another section of the Internal Revenue Code. So, lawsuits proceeds are taxable. However, there is an exemption for lawsuit proceeds awarded as a result of physical injury or sickness, limited to that which replaces lost income. So those are a few examples of taxable income not commonly known by the taxpayer that should be reported. So thank you all for tuning in, and I hope you were able to take something away from this information today. If you enjoyed what you heard and you want to know more, just follow me on social media via Facebook, Twitter, Instagram, and LinkedIn. Thank you.